Most people question whether or not property prices double every 10 years. So let's look at the data. Let me give you a history lesson on properties doubling in value. So if we look at how long it took for a property to double in value, we can find data as far back as 1963. So from 1963 to 73, property prices doubled in value in 10 years. Then from 1973 to 1980, which was 7 years, they doubled again. From 1980 to 1984, so 4 years, so that was an awesome time to buy property. Then 1984 to 1993, which was 9 years. And then it took 11 years from 1993 to 2004. And then most recently, it was 12 years, 2004 to 2016. For a property to double in value in 10 years, the annual growth rate needs to be 7.2%. Now, if we take that last 12-year chunk, 2004 to 2016, the 12-year increase, that works out to be an average growth rate of 5.9% per annum. Now, in the last 4 years in New Zealand, from 2016 to 2020, we've seen 5.8%. So we're pretty on track to get that same level of growth moving forward. When I'm working on projections, when I'm looking at an investment for myself, I would generally use a 5% capital growth rate as an annual growth rate if I'm looking at anything outside of Auckland. And in Auckland, I'm quite comfortable using, say, a 6% growth rate. Now, this is on the assumption that it's a standard property, so something that's not completely unusual, a room-by-room rental, an apartment with, dual key access. It's something that's just a standard investment. If I'm using something that's more yield focused, I might use a 3% capital growth rate just to be conservative. I think it's always important to acknowledge the other side of the argument, and that is that property prices might not double in value in the future in X period of time. And I guess it's fair to always look at that side. And people that have that challenging view might always be saying things like, hey, look, it was a one-off event that caused the market to increase and double in value. And they might look at things like in the 90s when baby boomers were hitting peak income age. And so then that puts a bit more steam in the market because there's more money for borrowing. And that might have been what caused it back then. So at the time of recording this video, and at the risk of being wrong, some of the one-off factors that I'm seeing right now, and we've got a COVID lockdown occurring, you've got people coming back to New Zealand, and that's helping with high net migration numbers. You've got record low interest rates, so sub 3% interest rates. You've got a shortage in certain cities like Wellington, for example, and you've got builders not able to add stock onto the market fast enough to accommodate the demand that's happening without all of these things piling up yet. One of the myths that I want to debunk for a minute now is just this whole idea that we're all leveraged to the eyeballs. And yes, when a first home buyer goes out and buys a property, they probably have a 90 or 95% mortgage a lot of the time. But the average mortgage in New Zealand overall is about a third. And so it's about $188,000 that people actually owe as a new mortgage. And so the interesting part about this is that people have a whole lot of equity in these houses. It's not that we've got a huge amount more debt. In fact, in the last 13 years, the debt levels haven't even increased as a percentage. So the percentage of debt to income ratio is just the same as what it always has been 13 years ago. When you factor all of these things together, it's a pretty compelling argument that there will be growth of some amount in the housing market moving forward. It might not be 10%, it might not even be 5%. But even if it was 2%, if you're using leverage, that's a 10% return based on the amount that you're putting in if you're borrowing that money to invest.